All right. Good morning, everybody. It looks like the UK followed PAL with no change. They are going with the prove it to me. Can't blame them, I suppose. Let me get the rest of this finished so you can see my screen. Although I guess it would make a decent podcast, huh? Except you can't see any of the levels. Wouldn't that raise a ruckus? So you might think it's all over. We're done. We're past it all. Nope, not yet. We got all the QRA out of the way. We have the FOMC out of the way. And Powell took all doubt off the table yesterday when he said that there is not going to be a March rate cut. I mean, he didn't set it in stone, but he said highly unlikely that there would be a rate cut, and the market took him at his word, and that was it. So one of the things you want to continue to watch is the CME Group Fed Watch tool for March. We know that they need to unwind this. Now, it's not likely it's going to go all the way to zero. I wouldn't stress that you need to see it do that. But you're going to want to see it get down to around 8 or 10. And until it does, we expect weakness in the indexes. It doesn't necessarily mean that we're going to sell off. And I want to stress that. I've seen a few comments yesterday about, oh, well, that's it. I'm just going to grab some puts. Hold up now. You might be better off, say selling calls than straight up buying puts, because this unwind might weaken any drive higher in the S&P or in the NASDAQ, but it doesn't necessarily mean that we have to go down. There's still a lot of other industries and sectors that are doing good. And with earnings still on the table on some of the Mag 7, going down isn't necessarily 100% guaranteed. So we're looking for enough weight on the market to really hold back any sort of rally, but we're also looking for enough structure underneath this market to hold us up and stop us from really selling off. We'll know when this weakness is about done, when this weight against us is past, because this number will get down to around 8 or 10. This is a free website. You don't need to pay anything to see it. Just Google Fed Watch. You'll see CME Group. You get this. A month ago, there was a 73% chance we would get a rate cut in March. They've unwound that down to 33%. So that kind of just highlights what I was just talking about, that they can unwind, and it doesn't mean we're going to sell off into oblivion. So, temper your enthusiasm for them puts a little bit. Small caps are up the most with 1%. The NASDAQ running right behind that. Remember, tonight we got Apple and a few others. I was looking at Apple yesterday. Microsoft sold off in part because it had rallied a lot and people took profit. And it sold off because their earnings had to be extra spectacular. They're not just good. They not just beat. They had to beat by a very wide margin. And the bar was just set too high and it sold off. That's not Apple. Apple's been beaten down. It's had a lot of negative press. Everybody has lowered the bar for Apple. And I think it can just easily step over that bar that's been made. So I grabbed some calls yesterday. I threw some butterflies across the tops. I've got some ratioed flies on it. They're all basically lottos. I don't think any trade that I have individually accounted for more than, say, $25, $30 at most. But I didn't have any puts. So I might pick up some today if I find something cheap just to try to hedge the other side of my trade. But I'm looking for Apple to throw off the negative reactions that we've seen so far in this space. it's been doing the opposite of everything else, right? So if everything else in the Mag 7 is going down, maybe now it's Apple going to be going up. Don't get me wrong, though, it still has a lot of issues. We got the S&P at about 0.5%, and the Dow down the most, which when we get to the growth value chart, right, we're going to see this really playing out. Hong Kong slightly positive. Yesterday it was looking a lot better as we got into the afternoon. So those China ADRs and the EV space, something to keep an eye on. So we got ISM manufacturing, construction spending, and that's a big deal. But the last big thing for the week, the one that really matters, is non-farm payrolls tomorrow and the Mag 7 earnings tonight. That's the last two very large economic events that are left on the table. I thought there was something for Japan that we really needed to focus on, and I don't think it's this monetary base. So might have my day wrong on that one. You know, I coach a lot of people from around different locations, and time is always an issue trying to figure out where people live in their time zones. But keeping track of Japan has just been an effort and frustration. It's 9:40 p.m. in Tokyo right now, just to kind of put that into perspective. Remember that we're still expecting to hear from other Fed speakers over the weekend. The blackout period has ended. I'm sure they're going to be coming out chipping teeth, maybe walking back some of that definitive March statement that Powell made. That'd be something worth really keeping an ear out on. There was a policy release right before Powell spoke. And if you go back and you read that release, they said it even in that release that, you know, a March cut really wasn't in the cards. They didn't straight up say there won't be one. And really, if you read what Powell said, he didn't flat out say we won't. He just said it was really unlikely. So we want to be really paying attention to all these Fed speakers that come out and see if they really start walking that back. We are underneath VWAP for the week. That's the anchored VWAP in yellow. I started, you know, Sunday night, Monday morning kind of thing. We broke through it. We're now underneath it. We've been underneath it. I meant to point it out yesterday. When we popped to the upside yesterday during FOMC, we failed to get through that anchored VWAP, which is just really cool. I love them anchored VWAPs. Got different anchors for the ES. I have one at the start of the year. I have one at the start of the month, at the start of the week, and at the start of the day. Now, we just got through January, so the new month would be right where today's is. That wouldn't do us any good, so you don't see it yet. If we can continue to get this dollar down below 103.5, preferably below even just 103, we could see the S&P and the NASDAQ, you know, try to reclaim some of these levels that it gave back. But we have the 2-year as well, kind of holding this level. We sold off nice over earlier in the week from 4.38 down to 4.2. So we want to see this hold these lows. We don't want it running back up. We don't want the dollar running back up either. The Mag 7 This is a daily chart. We closed below that 20. We closed below the 10. We're getting a 410 cross, which is a surge to the downside, but we're up this morning in the pre-market. So we're getting red to green here. This is a really big candle. One step at a time. We need to get through the 50% mark of this candle to half back. And preferably, if we can't get outside of this candle today, we want to close in the upper portion of this candle today. We're going to be gapped up this morning as we come into the open. And one of the things that we really need to do is not fall back down outside of this mag 7. We're not even to the 50% yet. So we have a little bit of room still to even work through that issue. We are back above the 20. And in the bigger picture, when I zoom out here, I mean, this is still a bullish chart. So, keep that in mind too. It's still bullish, and this pre-market gap up is strong. That's good for tech this morning at the least. All right, this is growth versus value. And we had that big gap down. Now we're going to have to see what we do with it. If this turns back around, we're not going to see much in the pre-market yet. I think we might start to see something printing on this, at least a pre-market label, somewhere around 8 or 8:30. But we're going to want to see this hold the line like a Busby from this breakout level. We've pulled back. Hopefully we find support on old resistance and begin working our way back up to these highs. $7:30, $8:30, $9:45, $10, $10:30, $11, $11:30. Nearly every hour on the hour until we get on the other side of lunch, including additional auctions, and they're all in the front end. So you could use something like IRX and kind of get an idea of what's going on. But that's a lot. So it's going to be one of those days. You're really going to want to watch the clock and anticipate that unless a narrative sticks that drives us through the day, we're very likely not going to get one of these kind of days, up or down. A consistent, persistent push in a single direction with minimal pullback, minimal profit taking, and it just kept going in one direction. It's very unlikely we'll get a day like that today unless one narrative comes out of the group strong enough that really propels us and continues that momentum in either direction. Doesn't even matter which direction. Especially with non-farm payroll on the table tomorrow. Granted, with what just happened with Powell, it's not like jobs aren't important. They are. And he touched on it a little bit yesterday. He even started getting into wage. But that's not going to be enough. We still need these numbers. And I think really we'll just have to see tomorrow morning when it comes to, is there a market maker move? How light is the volume? And then just kind of play it by that point. We have a really big day from yesterday. So we're inside. Inside days are great. It can form an IX10 pattern, and then we get these really fantastic trade opportunities. But when we're IX10 inside of a really big day, it's worthless. It's not a good setup for the simple fact that the IX10 is good, because it helps us identify a compressed market that's wound up a lot of energy so that when it breaks out, we got this expectation of a really good move. But when we're IX10 inside of a really wide range, then it's just a really big range with a normal procedural breakout, and it loses that expectation of high compression breakouts. Generally speaking, when we're trading inside of yesterday's range, the trades are going to be more violent, choppy. Price is going to be more difficult. So I'm not telling you don't trade when we're inside day. Just that if you're already losing more often than you win and you're struggling to be profitable, quit doing the hard stuff. And one of the hard things would be trying to trade when we're inside day. The smaller the inside day, the harder it is to trade inside that day. We're in a pretty wide range if you look at the distance for yesterday. So we have enough room to do some trading. Before I start laying out measurements, we might as well hit the pivot points. We're underneath the weekly pivot point. We're back inside the previous week's range. We're inside the close. We were looking at an MDP, but we've hit it. Yesterday, we managed to go all the way without hitting that daily pivot point. So we have a confirmed MDP from yesterday, and we're dealing with it this morning. Zero gamma, 48.42, with the volatility trigger at 48.81-ish. We're really close to the ADR half. If we get to the ADR half this early in the day, it opens the door for us to go to the other side by the end of the day. So we want to watch how the S&P deals with this ADR level, which is also tied in with the first move that we saw out of the market when FOMC minutes, the decision was released. If we were going to reject and head to the downside, it would be here. If we do make that trip to the downside, the previous week low held as support yesterday, not perfectly, because remember, liquidity resides on the other side of the pivot. We got through that pivot, and we got into liquidity that held the line, and we came back up above it. But support often gets tested once, maybe even twice before we cut through. Liquidity gets absorbed, right? So we get back down into that liquidity and we continue to absorb it until there's nothing there. We can cut through it and continue that move to the downside. So the fact that it held and we came up, be cautious. We're talking about basic trend logic 101, that when a market is making a move, it will often pull back before it continues a move and pulls back before it continues a move. Sounds familiar, right? It's trend trading 101. So from the high, came down, hit a pivot point, pull back. We could continue that move to the downside. I mentioned earlier in the week the fact that we had brought our weekly pivot point up considerably from where it was last week. It was all the way down at 48.29. So as we opened up the new week, we had it right underneath our feet. And we really weren't able to get very far away from it before now we've cut through it and we're on the other side of it. Generally speaking, when we're underneath the weekly pivot point, we're bearish in the market. Volumes within a normal range, and there's no market maker move. So we don't have any expectation that they're scared or that they're sitting out or that they're hedging. We are underneath the half back for last week, 49.03. You could just call it 4,900. Generally speaking, we want to close in the upper portion to kind of keep a bullish bias. But even just maintaining these highs would maintain a bullish bias. As much as it seems like we should be done already, this was a really big move from November. That was the last QRA, by the way. That October 31st, November 1st, QRA lasted all the way up till now. It's a lot of movement. We could sit here and digest a bit more. It wouldn't be bearish. In fact, it'd be bullish for us to digest this range, really correct through time, and then expand beyond 5,000. If we measure just yesterday's level, 4,900 comes right back into focus again. It's the line that we need to get through. Yesterday's half back. Otherwise, if we reject off of that, then we want to focus on yesterday's close and then yesterday's low to see if we're going to get any help at that point. It is day one, so not just in the ES, but across the board, you have your day one open range. It's the door setup. Mark your levels out for that too. $10-day, 30-minute volume profile. We did manage to cut below that 48.85 area, whatever you want to call it. We had talked about it as the last line in the sand, that if we cut below this, we got this drop waiting for us, this air pocket. We managed to find some support down here. So now we're just looking to see if that's going to hold. Notice though that this is where the TPO point of control is down here. So looking at the chart with all of this movement all over the place, this is where time has been spent the most. The TPO is time, price, opportunity, volume by time rather than volume by price. So really, if we break that low set yesterday, there's not much to catch us down here. We do have the classic P shape, at least on the TPO. It's a little sloppier over here on the volume profile, but it's kind of there. Just we're going to lose a little bit of this as the morning goes on. This last little bit down here is going to be gone. And as we cut through that, the range is going to get a little bit smaller. By the end of the day, Friday, all of this lower section is going to be gone on both of these profiles. And what we will end up with at that point is the classic D shape with nearly perfect point of control in the middle of it, at least for the volume profile. All right, so we cut through some point of control yesterday, and that means we get a chance to see that first touch play. So for people that don't use this, they don't quite understand how it can be useful until they see it. This VPOC has been on the chart for a while. I mention it as a first touch play. That's an example of a first touch play. It's not like we rallied to the moon. We just tagged on it, had an issue with trying to get through it in the first shot, managed to get through on the second turn. We don't need it anymore, by the way, so we get rid of it. And then we had another one down here. Even with the speed and the pace of that drop, that's where Powell said likely no rate cut for March. Drop down, first touch held. Another one down here. and it held. So it's not like support and resistance. Those are past tense words. It's just an area where we anticipate a reaction at a price. We consider the idea that there's going to be a first touch at least, and that we won't cut through those levels at the first glance, right? It's going to take a little more than that. Yesterday did give us a new VPOC. $49.11 cog line. So any move back up is going to have to get through that. We've got a couple of levels above us to deal with. Just for an example about how you can set up these levels, I was getting ready for FOMC yesterday, like everybody else was. And so I got my chart together and I took a picture of it and posted it, of course. Here's an example of getting the chart ready. It's about 1:30, 1:45, getting close to 2 o'clock. And I laid out some levels real quick. Got some FEB levels, low a day, low a week, high of day, high of week, a gap that needed filled, and a key level 48.50. These other two, while the labels aren't here, they were gaps from farther back that still need filled. But just kind of laying my levels out and getting ready. So, you know, all these levels that we talk about, if you put too many lines on the chart, we all know how it is. You just get overwhelmed by so many lines, you can barely even see price, right? So maybe you don't want all the lines all the time. You only want some of the lines when they're relevant and when you need them. Talk about relevance. There's that 1, 2, 3, 6 yesterday. Perfect connection with it. And by the end of the day yesterday, that key level really came into play. Now, we did end up breaking down at the very, very end of the day. We did cut through that level. But you can see clearly that laying out some levels at least gave me a roadmap and some expectations of what to look for at a price. These are not complex levels. High of day, low of day, round number, large option levels. So when we have them all over the chart, you know, this can look hard to deal with. But start taking them apart, put them in there piece by piece as you need them, and it's not so bad. So one of the things we have left to deal with this morning, and we couldn't really do it with all that stuff on the chart, is this big move. So one of the things that you can do is mark out the 2 o'clock time frame, because we know that that's when the report came out. And then that statement out of Powell, it had looked like the market had kind of settled in, had an idea of what it was going to do going forward. It was making the move up, and then he made that statement, and they had to scramble to readjust. That left a lot of people caught off sides. And I'm going to believe that this is an area of unfinished business. If we were to look at it on another time frame, it's very likely the same setup as a rally base drop scenario. So this entire zone is now an area where when we get into it, we expect that we're not going to get through it at first shot, that it's going to take us more than one try to get through there. Now, you can call it all kinds of things. I tend to call it unfinished business. It's the easiest, non-complicated thing to say to somebody, especially if they're newer traders. So it's an area of unfinished business. And when we get back there, we're going to expect people to try to get their business finished. It's going to be very hard to get through that spot. We can measure big candles. For that, I generally go to a particular time frame, say like the 5-minute. But we're already on the 15, so I'll do it here. So we got that half back level to deal with. It's not a random spot that I picked. It's after he made that comment. Notice that it lines up with my ADR half. Like I've said before, when you lay out levels that come from different sources and they all line up, it just shows that you're doing things right. Right? If your levels are floating in the middle of nowhere and they don't line up with anything else, you're probably off somewhere. So this is a really good level to maintain. If we do go down to that 5-minute, we want to hunt for which candles to measure. This was a series of really big candles all at once. So, we look at that and that makes it a lot harder to try to pick and choose which candles to deal with. We could choose just those original ones before the pause at this consolidation area. And that gives us another level, another half back zone. And then, of course, there's the entire day of yesterday. And the open of yesterday, which is a really big deal. So a lot of work overhead. To the downside, things are a lot cleaner, a lot easier. We can start with getting this gap filled down here. Then we can get through the 4 o'clock close. If it isn't the same, it kind of looks like it is, but if it isn't, then we got to get through that as 2. Then we have yesterday's low, then the ADR half at a key level, 48.50. Below that, 48.27, level by level. For what we already have this morning, we can measure our Globex. And we can get those levels as 2. That way we at least have something in between these ADRs. So you got a lot of levels just from that alone. And then, of course, we turn everything else back on. You got voodoo lines, floor pivots, the weekly pivots that we can add, and then the VPOC, kind of wrap it all up. So VIX is down, Bitcoin, and really to the downside, that's it. VIX and Bitcoin. To the upside, uranium, banks, China ADRs, the Mag 7 communications, semiconductors, just about everything else, which is a good thing. We want to see that wide breadth this morning, right? That we don't want to have to go in to a stock pickers market this morning. We want to see real diversification between what's moving to the upside. Growth, value, small caps, mid caps, large caps. We want it all showing that it's holding the line. It doesn't have to rally like a mad demon, just hold the line. So we got a little bump in uranium. We're still digesting these highs, but uranium's been doing really good. So, you know, it's not a space that has really great options, so it's, you know, easily overlooked. But it's been doing really good. And we're back up again with it this morning with an inside breakout. The China ADRs, I mean, you know, we're up off of where we closed, but we're still trapped inside of yesterday's range. So we do want to see a change there. This is going to be your BABA, Baidu, JD, PDD, maybe even NEO, Lee, XPEV, right? Those EV markets. Then we got the small caps, which again kind of tie in with EVs a little bit, but also with solar, which we can see that solar is up as well. EVs, solars, some Bitcoin, except Bitcoin is down. That'd be a good one to see for a turnaround. Is get Bitcoin with a rally, kind of, you know, rising tide scenario. Lots of tech, whether it's communications, semiconductors, just the queues themselves. We got energy up with XLE, which closed really at the lows and is kind of rising up a lot like the rest of the market is. Right? When you kind of think about how the S&P closed at the lows and it's trying to rise back up. Energy and the SPX or the ES of SPY, they look a lot alike this morning in that regard. Their daily charts sure don't look anything alike. And of course, emerging markets, that's just more China. Yeah, they don't deserve that title anymore, but I guess that doesn't matter. Bitcoin is down significantly, but a turnaround here would be fantastic. There's this concept, and I've mentioned it for a while now. It's not mine, but man, as soon as I heard it, I loved it. I've been really keeping my eye on it. When they're done buying Bitcoin, they'll move into the China ADRs. And that statement was said back in like November. Remember when we were all still waiting on those Bitcoin ETFs to pass through and be approved January 10. And so we kept seeing Bitcoin bid up, bid up. We got through January 10. We're done with that now. And we're seeing that weakness begin to unfold in Bitcoin. It's set that high. It's really been kind of just easing back off of those highs ever since. And now we're focused more on those China ADRs, even this morning. And, you know, it's not like Hong Kong's up a significant amount, but it is up this morning and it's in the top 3. So if we can continue to see that rotation out of Bitcoin and into China ADRs, that's really going to help out. But I'm going to continue to stress caution because that whole Evergrande situation is still weighing down over there. And they're doing a lot of work to try to pop, or not even pop, to prop their indexes up, right? They're trying to hold the market up over there. There's a history of this. They've done it before, but I don't know enough about it to really speak on it. Just something to consider, right? To be a little cautious with those China ADRs. So we got BABA this morning, nice gap up. It's holding the inside day breakout, at least for the moment. We got to get above 73.5 to continue this drive. And we could easily get, this is kind of a really sloppy, really ugly TRB, but we could get back up to 75.5 on this breakout. I know it seems like a lot, but here's a candle not too long ago that showed that it can easily do it, right? And that was the half back test, which, you know, we might have overshot it a little bit, but it held, and now it owes us back to the top. So as BABA kind of fits in with the whole K-Web thing. Got Baidu. This is not looking nearly as good as BABA was looking. JD. PDD, which doesn't even want to load. There it is. This thing's just been, getting beat down after falling out of that zone, and it's still under the halfback. We had a pretty strong sell-off in gold yesterday, so it's not a surprise they're up a little bit. More likely a reflexive bounce than anything else. And for pot stocks, we're not really up and moving here yet, but we're not sold off. It's above all these anchors, the volume anchors. There's some selling pressure in that 950, but if we get above 950, this thing could really rock. Get back towards these higher levels, get above 10. It's got some work to do. I think that monthly chart just kind of says it all. All right, so a broad market rise this morning, but we're trapped inside yesterday's range across the board in most things that we're looking at. A few individual things are broke out above yesterday's range, but most things are still inside it, and that's going to be your biggest threat. If the S&P and the NASDAQ fail to break out of yesterday's levels to the upside or the downside, then 80% of the market is also going to fail to break out. So it's not likely to have very much follow through. If I'm day trading and looking around for equities and stocks, things like that to trade, I'm going to be focused on things that are already inside day breakout. Everybody be careful, be safe. I'll see y'all tomorrow.